ready? You got me running, you got me running, got me running. Shake it, shake it, shake it, shake it. Raise your hands up, raise them out.
Hello, everyone, and happy Thursday. It is the 17th of February, and welcome to another episode of the Daily Currency Call presented by Forex Trading Asia. And a big welcome to everyone watching the stream live as well from the LCMS Traders Club. Hope everyone had a good session yesterday too. There was a little bit going on, as there has been this week, and the drama continues with the FOMC meeting minutes coming out as well. Kim Hong will do a summary of that as well. There was definitely a few key points to be discussed. We've got the yen and gold in focus, and I'll be going through the US dollar index. But before we get into the episode, I'll just share the risk disclaimer as well, because we will be sharing trade ideas, and it's important to understand that any information shared in this video is not intended to be a trade recommendation. It is solely the opinion and views of the speakers. So please remember to do your own analysis prior to entering any trades. So as I mentioned just before, we do have Kim Hong here, just going through what was released earlier this morning for us at 3 a.m. GMT +8 with the FOMC meeting minutes. And to summarize, I'll pass it over to you now, Gimme.
All right, thank you, Scotty. Well, the FOMC meeting minutes was a bit boring, I would say. Okay, so as pretty much expected, no surprises. Okay, no details on rate hikes path was being provided. Okay, meaning they did not mention if how many rate hikes will be made. At what kind of denomination will the rate hikes be carried out, 0.25 or 0.5 or things like that. Maybe how aggressive they are going to run it, okay? So at the moment, okay, no sign that a 0.5% rate hike will be carried out in March, okay? It may very well be 0.25, okay? So I guess we just have to wait for James Bullard to actually, try to convince the other members that March will be a good time to carry out a 0.5% rate hike, okay? But nonetheless, there are still a couple of points, okay? I would say more or less like emphasize the points that we already know, okay? Emphasize maybe like, to a further extent. Okay, the first point over here is this, okay? Well, this is actually regarding interest rates hike, okay? I think I should start from here. So participants discussed the implications of the economic outlook for the likely timing and pace for removing policy accommodation, compared with conditions in 2015 when the committee last began a process of removing monetary policy accommodation. Participants viewed that there was a stronger outlook for growth in economic activity, okay, substantially higher inflation, and a notably tighter labor market. Consequently, okay, most participants suggested that a faster pace of increases in the target range for the federal funds rate than in the post-2015 period would likely be warranted. Okay, so something good over here, right? Something hawkish. That means they are likely going to increase interest rate faster than back in the 2015 period when they were actually doing rate hikes. Okay. Should the economy evolve generally in line with the committee's expectations? Of course, if let's say the recovery were to carry on to be strong, inflation continues to rise very, very fast, okay, run hot, run wild, then okay, the FOMC will probably just hike rate faster than back in 2015 when they did it the last time, okay? And even so, participants emphasized that the appropriate path of policy would depend on economic and financial developments and their implications for the outlook and the risks around the outlook, and they will be updating the assessments of the appropriate setting for the policy stance at each meeting. So at the moment, I would say, what this chunk over here is trying to say is that they are open, okay? The Federal Reserve, they are open to a more aggressive rate hikes, okay, in the near future, but it all depends on how the economic recovery were to progress in the near future. So it's a bit of a one step at a time. Okay, the Federal Reserve is taking things one step at a time and see how it goes. So they are not actually telling us that we are going to go all in. Okay, we are going to go full throttle on rate hikes at the moment. Okay, and then the second point. Okay, so this is on interest rate. The second point is actually on quantitative easing, or should I say the unloading of bonds. Okay, let me wait a minute. Participants. Okay. So as we all know, okay, the quantitative easing bond purchases under the QE program, okay, will be ending in March. Okay, so the next move will be, when will they start unloading the bonds? Okay, aka selling back the bonds to the market, or maybe to stop carrying out any reinvestment of the maturing bonds. Okay, so over here they say that participants observe that in light of the current high level of the Federal Reserve's securities holdings, a significant reduction in the size of balance sheet would likely be appropriate. Okay, a significant reduction. So I think they are really trying to, in terms of quantitative easing, or in terms of bonds holding, they are really trying to, sort of like unload it as soon as possible. So providing less support to the market and things like that, so that they can, have more flexibility when it comes to rate hikes in the near future. Participants noted that the level of securities holdings consistent with implementing monetary policy efficiently and effectively in an ample reserve regime was uncertain, and probably will remain so. Consequently, market conditions would have to be monitored closely to determine the appropriate longer run level of reserves and the size of balance sheet. So they're going to start unloading, but how are they going to do it? Because they have treasury bonds, and they have the what's the other one again? The mortgage-backed securities, agency mortgage-backed securities as well. So will they be selling it back at one go? At what rate? Or maybe to not carry out any further reinvestment or to reduce reinvestments, right? So there are several options, or I would say combinations, for the Federal Reserve to take, to carry out in order to in an attempt to actually reduce their bonds holding. Which brings me to the next point over here. So this section is actually it actually talks about the principles for reducing the size of the balance sheet. So in point form, there's one point that I think it's worth noting is this. The committee intends to reduce the Federal Reserve's security holdings over time in a predictable manner, primarily by adjusting the amounts reinvested of principal payments received from securities held in the system open market account, SOMA. So I think, at the moment, as of now, as of the most recent meeting, the central bank, will probably want to take up this whole approach of, just cut down the amount of reinvestment made to the maturing bonds, maturing assets. So right now, prior to this meeting, they may actually be carrying out full reinvestments, of the maturing bonds, but as of this meeting, they may actually adjust it lower. All right, so not that aggressive, if you ask me, at the moment, when it comes to unloading of their bonds, because this is a bit more like I would say the slowest approach, because if they were to go aggressive, then they will actually be actively selling back the bonds holding to the market. Okay, but like what the Federal Reserve has already mentioned, that stage will only arrive when the first rate hike takes place. Okay, so at the moment, not really. So it will depend on whether or not in March, during the March meeting, the central bank will be carry out a rate hike, which personally, and I believe many in the market, at the moment believes that they will be carrying out interest rate hike. It's just a matter of whether it will be 0.25% or a more hawkish 0.5%. Okay, so that's pretty much it for the meeting minutes. No surprise, nothing coming in, no timeline of interest rates, and I would say, more details on this whole unloading of bonds being provided. Okay, so any questions on this meeting minutes? Okay, no questions for now. If that's the case, then I will hand it over to Scott for his analysis on the DXY. Over to you, Scott.
All right, thanks, Gimme. Just before I get into that, I've just got something to share. The 2-year bond yield, it's been an interesting little relationship with the US dollar. We did see the 2-year Treasury bond yield ease down a little bit. This is the 1 month. If I zoom out, you can obviously see the significance of the rise with the impending news, of the first interest rate rise coming as well. And obviously the Fed is trying its best to just calm and settle things, but it is an inevitable situation. So it did ease off a little bit. There was some mixed news releases out on what is actually happening with Russia and Ukraine as well, whether the troops have pulled back, and apparently it is happening, and then it's not happening. It's all just a bit of a mess. So I would warn everyone just to be a little cautious, and we'll get into the US dollar now. We did actually see the US dollar remain pretty sold off, in fact. So on the daily chart, we're at around 95.80 or so, and I'll just 95.78. So I'll just go now to the 1 hour time frame, and as you can see, this is the situation we've got. So we did see some selling as markets were a little bit calmer on the back of what was happening, and there wasn't really a lot of news out last night as well. We did bounce off 95.67, which we've seen bounce before. We have 95.50 and also 95.20 to contend with too. And the bullish case still remains on the US dollar. It's just markets seem to be digesting what the FOMC meeting minutes had in them. And there wasn't, like Jimmy said, not a lot of substantial hawkish remarks. Everyone's just trying their best to contain the situation. And I'll just quickly share the news now as well, just to summarize what happened last night. So the US, we didn't really have a great deal of news out on Wednesday. We did obviously have the FOMC meeting minutes out, and then we've got this US unemployment claims 9:30 tonight, and not really a lot, to be honest. G20 meeting starts, and we've got FOMC member Bollard speaking. But really the theme right now is just there's still a lot of uncertainty, and then we add what's going on around the world with the situation, especially with Russia and Ukraine, and it's just a continuing situation. So be cautious with how you trade. So for the US dollar, really, if we go down to Friday for tomorrow night, just a lot of FOMC members speaking. So be flexible with the range that we're in with the US dollar. So I would say it needs to break over 96 for me to think about going long. And I would say it's just a bit of a gray area from now until the next time the FOMC meets. It's just going to need to really get propelled on the back of some significant news. Or it could be the fact that something might happen with Ukraine and Russia. So for now, it's a bit of a stalemate on the risk sentiment. I feel it's sort of neutral, but very tentatively, it can be easily pushed, especially easily pushed to risk off. So be careful with the risk on currencies as well. Is how I'm sort of taking it, but bullish on the US dollar back over 96. So I'm out for now until that happens, guys. So those are my thoughts there. Now we do have the yen, and we've got gold in focus as well today, given it's Thursday, and we've got Jin here just to go through some possible trade ideas. So I'll pass it over to you now, Jin.
Thanks for that, Scotty. So yeah, as the guys have been sharing with you, we had the FOMC meeting minutes released. Not much happened there. Not telling us any big surprises. We did have the dollar testing a little bit higher and then sitting back in that consolidation again. A lot of unknowns at this point, and as Scott was just sharing with you, the troops moving to the line or away from the line. One thing that I did notice just on the news there was that 2 hours ago 7,000 more troops to the Ukrainian border, right, despite claiming that it's going to negotiate something. So all that uncertainty has really thrown a big mess, a bit of a mess to the markets. So what to look out for? Looking at the yen pairs in particular, because of yen as one of the reserve currencies, tend to have a little bit more volatility during this kind of periods. So we could be looking towards, let's look at the USD JPY to start, right? So USD JPY, what we've seen there is, like when we last spoke about it, this is on the H4 time frame. If it tries to break above and close above that line, we could see that further upside, but it didn't. So we're looking for it to track lower. This was the last time we spoke about it on the 15th. With the Traders Club members, we're looking for it to close below and test lower. So I think this view still holds. What you should be looking for, if I move this across, is if Russia and all that does still escalate more troops towards the lines, look like a bigger risk, we might see more flow towards reserve, and in this case for the US yen, we might be looking for it to come down towards that 115 level. But in this case, your stop loss might be about 30 pips above this resistance, above this 115.68 resistance. I would say that might be a little bit high. You could put 30 pips, but manage it. If it does come close, you could close out earlier. Take profit would be about 115. So you're looking at almost a 1:1 or slightly greater than a 1:1 risk reward ratio towards the downside for the US yen. In this case, I would say look to sell below 115.40 to trade it down towards 115. If it does break below this point, then we could see significant downside towards that 114.20 level. So this could be a two-part trade. You could be looking for a quick one, a quick 40 pip towards the downside. And then also, if it does break below that point, you could be looking for a tight stop loss of 20 pips for a good take profit of about 60 pips, or 1:3 towards the downside for the US yen. But bear in mind, we are at Thursday with Friday coming up, and then over the weekend, we might see a lot of moves over the weekend. If you're not comfortable with it, try not to hold your trades through that weekend. I think that we might see a lot of breaking news over the weekend. That's my view. Following on from that, on the US yen, looking at the Euro yen. Euro yen looks a little bit different to the US yen. I think in this case, we might be seeing a little bit more of a different move, right? So the last time we spoke about it, it was sitting at this 132 level. We have both the upside and the downside potential. If you did jump into those trades, you would have had both the upside and the downside. I like how it has reacted to this 130.60 level and bounced back up. What I would be looking for the Euro yen would be different to the US yen. I'll be looking for it to track higher, to track above that 132 level and look for buying opportunities. I think that we could be looking at the euro dollar tracking higher, which could drag the euro yen up. So as much as the US yen could be dropping, I think that with the euro dollar pushing higher, we could see the euro yen push being dragged up as well. So if we do see it track above 132.20, above 132.20, you could have a 30 pip stop loss. I wouldn't go as far as 100 plus. I would say even 90 pip take profit level. you would have a 1:3 risk-reward ratio towards the upside for the euro yen. This is on the H4 time frame. Same thing with the pound yen. Same thing with the pound yen. I really like how it has tested, rejected that 156.80 level, that 156.80 level. I think this will be a bit less of a waiting period. This will be a bit more immediate, where you could be looking for that buying opportunity towards that 158 level. So 158 is about 85 pips away. Stop loss could be, I would say, 40. In this case, we want it below this support level, so about 40 pips away. So you would have a 1:2 risk-reward ratio towards the upside. What I'm looking for here is buying opportunities above 157 for it to repeat that similar move as what happened early Feb, 10th of Feb, broke above, went straight up towards 158. I'm looking for that same play, that same trade to happen. If it does break above, again, with the pound dollar possibly pushing higher, we saw some good news from the pound dollar yesterday. If it does push higher, we could see the pound yen being dragged up because of the pound dollar, and also, possibly some downside to the yen, but not big moves. So I think that we could see it test 158. And lucky last on gold. Oops. On gold here, when we last spoke about it during the Traders Club session, we were talking about it. If it does break below that 1850 level, we could see further downside. What has happened is that we saw it bounce back up, right? Why did it bounce back up? Again, because of all the uncertainty that moved towards reserve. Gold is also one of the reserve. We've seen it track up towards 1868. In this case, I would normally suggest wait for it to track down, buy in value, buy at 1850, back up again. I think what we might see here is if it does break above 1878, it might sit in consolidation now over the next couple of days. But I think if anything does escalate over possibly into next week, what we could be looking for is buying opportunities above 1878 or 1880. I wouldn't be very comfortable keeping this too tight. I think you could be looking at a 1:2 risk-reward ratio towards the upside if it does break above 1880. I think that in particular, I would be looking at gold maybe a little bit on a second priority. I think looking at yen tracking towards the downside, the euro yen and the pound yen, and possibly some of the other major currencies first rather than gold at this point. But if it does break above 1880, we could see some significant move towards upside. Why I say that is because if you look at it on a daily time frame, it's been a long time since we tracked above 1880. This was May 2021, where it broke above. Same point where the take profit is, similar point to where the take profit is. If it does track higher from this point, we could see that big upward move, repeating what happened in May 2021. So it has to break above 1880 before we see any significant move towards the upside. With that, I'm pass it back to you, Scotty.
All right, thanks, Jen. And remember, it is Thursday, so there is the evening call later today at 8 p.m. GMT +8. And again, make sure you do watch the replay if you missed any of the trade ideas that were discussed. Remember the risk disclaimer too. And I hope to see everyone later today in the LCMS Traders Club, and hope everyone has a great rest of your day. Happy birthday again to Jen. Hope you have a nice day today. Plenty of pips. Bye, everyone.